What's up, guys? Raymond's from Raymond Sky Media / RayEnterprises here. In this video, it's a follow-up to the previous video, how to invest in stocks. This video is going to be based on how to pick a good company / good companies to invest in. What do I mean by a good company? That depends on your goal. So if your goal is to make a lot of money in the short term, your best bet is to choose a company that's growing, so that when you buy it low, you can sell it high. Then you can make money on the difference in price. Or if you want to make a regular income, then you can choose a company that pays out dividends or pays out part of its income every month or every 3 months, or once every year. So that's if you want to look for income investments, investments that pay you income. If you're looking for a combination of both, then you're going to look for companies that use their revenue or their income and reinvest it into the company, but they also pay a small percentage, maybe 2.2% or 2.5%, like Microsoft, to their shareholders. That's like a good combination of both. People might ask, what should I invest in, big companies or small companies or medium companies? That depends on your risk tolerance. Smaller companies are a bit riskier to invest in because they're more likely to fail based on economic scenarios. For example, now we're going through a coronavirus pandemic. A lot of companies can't create any revenue or much revenue. Their revenue has been cut dramatically because a lot of people can't go out of their house and actually work and sell their products or provide their service, so they can't actually make nowhere near as much revenue as they did previously. So a lot of companies need a lot of revenue to. They might have a lot of debt to be able to allow their company to continue functioning. So yeah, definitely look for companies that don't need much revenue, and or actually they could need much revenue, but they don't have much debt, so they don't need so much revenue to be able to pay off their debts. That's a healthy company. But also a company that has good economics in its favor. So for example, Coca-Cola, in an economic downturn like this, they can still make a lot of money because a lot of their money comes from distribution and even online. For example, online, for example, retailers like Amazon, eBay, you can still buy Coca-Cola. You can find Coca-Cola pretty much everywhere, and Coca-Cola has a lot of different ways of making money. So diversity in how they make money, and that's really good for a business to invest in, because then you're safe. If you invest in something that has a lot of ways of making money, then you know that you shouldn't be so scared, because you know that they're still going to be able to make money, and the chances of them failing are really low. Also, the potential to be bankrupt. So you need to look at a company's financial health, and you need to look at their financial data to look at how likely they are to go bankrupt, or what are the chances of them going bankrupt. And the chance of them going bankrupt is based on how much cash they have. So if you sold all of their assets, if you sold everything that the company owns, and you paid off all of their debts, and you paid all the shareholders, and you paid off everything that they owe, and if there's money left over, even if it's 1 pence or 1 cent or £1, then that company is net positive with regards to its health. With regards to its equity. So you know that the company can't. It's almost impossible for the company to go back, or unless they generate more debt, then it's impossible for the company to go bankrupt. The more they're in a net positive, the better the higher the chances of them going bankrupt. So yeah, those are good companies. Those are the type of things you need to look for when looking for good companies to invest in. I hope this video has helped you, and I'll see you next one.